Hi, this is Stephen here from Share Navigator, and you're just watching a trade we're about to place on Twitter. So it's the 28th of April. Twitter are announcing earnings after the bell, and we're looking to do a short strangle trade. So it's a combination of two trades. The first trade is we're going to sell a put option, and we're going to look at the $42 strike. And the second part of the trade is we're going to sell a call option, and we're looking at the $60 strike. So the bottom line is we want Twitter to finish after earnings tomorrow between $42 and $60. It's currently trading at $51. Um, on a contract basis, our full profit potential is $83 per contract. We're going to sell 5 contracts, so potentially we could make $400. But as we normally do, once we go into a 50% win rate on this, we just close the trade down. So we're looking to make about $200 out of this trade. This particular trade has a 79% probability of success, and it has two break-even points. The first break-even point is 41.17, so it must finish above 41.17, and the second one is $60.83. So it just needs to finish somewhere in between those two for us to break even. We will make full profit if it finishes between 42 and 60. Again, it's trading at 51 at the moment. So we've given ourselves just slightly less than a 20% leeway to the upside and to the downside on this particular Twitter trade. Now be aware, Twitter normally after earnings does move a lot. So, don't be surprised tomorrow if you see this up 10 or 15% or down 10 or 15%. But one side of our trade will win really big. The other side of our trade will look like a loss in the early days, but then it's how you manage it on an ongoing basis and you turn it into a profit. So review our Amazon trade that we just did if you want some more clarification on that. So just want to show you why we're placing this particular trade. So here's a chart of Twitter. As you can see, it's up here at around $51. We're giving it plenty of leeway up at 60, between 60 and 42 for this particular trade to work out. And the reason we're playing this trade is because of the increased option employed volatility. So you can see here it's up at 60%. And really what tends to happen just before an earnings announcement, employed volatility increases. You don't want to be buying options when employed volatility is high. It's very unlikely you're actually going to win in a trade when you buy options when employed volatility is high. So we choose to sell the options in these particular trades. And eventually what we want to see, like it normally does, this type of drop off in employed volatility. That means the option premiums get cheaper and we buy them back at a cheaper price. So ideally tomorrow what we want to see Twitter is maybe move 2 or 3% in either direction. If we do that, we'll be taking our 50% profit clear tomorrow. If one side of the trade wins big, it may take 4 or 5 days like the Amazon trade to work out. So we're going to place the trade now. I'm going to show you how we're going to do it. So we're in our trader workstation. We're going to click on Trading Tools and Spread Builder. And we're going to type in Twitter here. So Twitter's already typed in. Now we're going out to, we just want the May 15th expiries. That's all we're interested in. And we've told you the strikes that we're interested in as well is the $42 strike and the $60 strike. And so that's all we want. So we're going to sell the $42 put. So that's going to go over onto this side. And the other side of the trade is we're going to sell the $60 call. So I can see that the bid asks here, they're pretty tight for options just before earnings. So I'm going to look for 24 cents on this trade and I'm going to look for 59 cents on that trade. So I'm going to look for a net credit here of 83 cents. So we're selling here. I'm going to do 5 contracts. Remember to position size in these type of trade. It's really important. Remember it's a credit, so it's when we put a minus before it, that means it's a credit. We're looking for money in. We're looking for 83 cents. So we're just going to submit that. Now if you have a smaller account, you may only want to do 1 contract of this or 2 contracts. We have a bigger account here. This is real money that we're trading with, so we're happy to do 5 contracts. So remember your position sizing. We click on Submit. It's now giving us our last chance saloon. Are you sure you want to sell 5 Twitter $42 put options that expire on the 15th of May? We do. Are you sure you want to sell 5 Twitter call options that expire on the 15th of May at the $60 strike? Yes, we do, and we want 83 cents in the door. So we click Override and Transmit. So that trade has gone into the market. Now, because we're haggling with the market, we mightn't get filled straight away. I will monitor that trade as we go along today. If I'm not getting filled towards the market close, I might just drop my expectations on it. So I click on here, I can see my pending alls of an order in to sell our apple there or buy our apple back, and here's our short strangle. So I might change that, for example, now to 82 just to get filled. I click on update. And if you wanted to get filled, you might have to go, and this is the way you have to do it until you get filled on the particular trade. So we're going to leave it there at 81 cents. I'm not going any lower than that for them, and I'm going to let the market come to me. Okay, this is Stephen from Share Navigator. Thanks, bye for now.